On this video, we're going to do a compilation of some of my interest rate videos because in today's interest rate model, a lot of the things I've talked about, those things like the temporary buy downs, we're going to talk about permanent buy down, your 2-1 buy downs. I've been doing as much as 3 2-1 buy downs, and also a video about discount points. So this is a compilation of a few of my YouTube videos on my channel that all talk about interest rates because I know it's on the minds of my clients and it's probably on your mind as well. So you can go ahead and take a look at this. And of course, if you have any questions about what the interest rates are for you, right now it's June 2023. You know, rates are solidly in the 6s. Maybe I could touch the high 5s with a lot of point buy down. But you know, these videos will help explain what permanent buy downs are with seller credits, as well as 2-1 buy downs. And of course, if you have any questions about how these scenarios look for you, definitely give me a call. Definitely give me a call or go to tcmortgage.com, and I'd love to help you out. So here we go with the compilation, and here we go. Let's talk about how to get a lower mortgage payment in a high interest rate environment without spending thousands of dollars in buyer paid points. How do we do that? A 2-1 buy down. Let's talk about it. Okay, great. What is a 2-1 buy down? Basically, it's a loan program designed to help mortgage borrowers in a high interest rate environment, just like this one, to save money the first couple years of their mortgage. And it's accomplished by lowering your note rate 2% the first year, 1% the second year, and going back up to the note rate the third year, hence the name 2-1 buy down. So basically, rates are about in the 7s these days. So basically, your first year's payment will be at 5% rate, then 6%, back up to 7%. With the anticipation that rates will drop after all this Fed action of raising their federal funds rate to tame inflation, which will eventually bring long-term rates down. So if you go ahead and stay tuned to the end, I'll go ahead and show you a detailed example about what it looks like and how it's also much better than a major price drop. Okay, back in the office. A little bit loud out there, but it was pretty nice outside today, so I wanted to get out there. And I also wanted to show some of the Met Stadium. I know the Mets had a great year, but they kind of blew it at the end, so sucks for the Mets. Anyway, better luck next year. So those of you who haven't met me, I am Emmett Dempsey, mortgage broker and owner of Treasure Coast Mortgage here in Port St. Lucie, and welcome to another video. Go ahead and leave a like on this video. Go ahead and wake up the YouTube robots, let them know you're still there. Hopefully you get a like. If you don't, you dislike, you do what you feel you need to do. But go ahead and leave a like. Also leave a comment. Let me know what you think about, seller buy downs, 2-1 buy downs, see what you've heard about it. Or your general thoughts about the interest rate and the real estate market, the housing market. So let me know what you think, and I will look forward to talking. Okay, some frequently asked questions about the 2-1 buy down. So what loans can you do this on, and what kind of properties? So basically, you can do it on anything you're going to live in, roughly. So for a conventional financing, Fannie Freddie, you can do it on owner-occupied as well as vacation homes. You can do it on FHA, which is owner-occupied only, and as well as VA loans, because I'm a veteran, I have a VA loan, so I love to be able to help this with veterans, to help them save money in their first couple of years with the 2-1 buy down. So that's the kind of homes you can do it on. Okay, who pays for this buy down? Basically, it's usually the seller, somebody other than the buyer. So I know a lot of builders are offering this, a lot of builders, lenders, and I know for us, we need the seller to be able to fund this. And how much it costs, it's basically your first year savings plus your second year savings. Say you're saving $500 the first year and $250 the second year. You just add it together, $750 times 12, and that's the amount that the seller has to use in the form of a seller credit in order to fund this 2-1 buy down. Okay, so why would a seller do this? So they do this to help move their inventory. You may have noticed, the market has shifted a lot, so which is good for buyers. And you might start to see some price drops in your market. I know I start to see some in our market, although some other markets are worse than ours. But I think the last I saw, almost a quarter of the listings had some sort of a price drop. So instead of a price drop, the seller would ask you to pay their full price and give you a concession towards your closing costs. So you use this closing cost concession in order to fund this 2-1 buy down, save you some money in the first couple of years. Okay, great. So what happens to this money that the seller pays for? It essentially goes into an escrow account that finances your 2-1 buy down. Unlike a permanent buy down or a regular closing cost concessions where it's just one and done, this basically goes to fund your buy down. So if at any time between now and the third year you refinance, that money is yours. It gets used as a principal reduction for the refinance. And like I said earlier, this program is anticipation of rates coming down in that third year. Of course, there's no guarantees rates will, just general history based on Fed action and raising the federal funds rate to tame inflation, which will bring down long-term interest rates. That's kind of what we're anticipating based on the sources I subscribe to. Okay, let's go and get into the example. This one is for a general $500,000 property, but if you want your own personalized example, if you're on the listing side and you're buying, I can run this scenario for you. Just go to dempseymortgage.com and put in your information, and I'd love to help you out. All right, let's go and take a look.
Okay, here is a mortgage coach example of a $500,000 property and the different options to do once you get a sales concession. And as I said before, if you want a personalized mortgage coach for your listing or if you're buying a house, I'd love to provide one. Just click the link in the description. So to that end, here is the different options. So basically, the first column is $500,000 purchase price with 10% down. That's roughly the median sales price here where I am at in Florida. So basically, with 10% down, $500,000 purchase price, 450 loan amount, about a 7% rate. Yes, rates are that high these days. So roughly about 7%. So about basically 3550 payment, about 66,000 cash to close. Okay. So what are the options? Let's say the seller, your realtor negotiate a 3% concession. So what do you do with it? All right. So basically, the first one you do is a permanent buy down. Basically, use that money to permanently buy down your interest rate. Your interest rate doesn't change, so you buy down to about 6.25. So it only gets you about 0.75% off the note rate. With that same amount of money, saves you $223 a month. Okay, roughly the same cash to close. So that's a permanent buy down. Okay, so this is the next column is a 2-1 buy down that we talked about. 2% the first year, 1% the second year. Okay, so your first starting note rate will be 5%. So that's a $578 a month savings. Okay, and then but roughly same cash to close. Okay, the next one is because what if I just ask for a price drop? So the thing about a price drop is you don't get as much off of your payment as you think you do because it's all scalable to the amount that you're financing. So if you're putting down a lot of money, or if it's basically it's major if you're paying cash, but if you're financing, a price drop is really not as great of an option as you think it is. So, and don't let them say that a price drop equals a concession. They're very, very different. The concession will go to your bottom line, whereas a concession or a price drop is scalable to the amount you're financing. So what would happen? Basically, a little bit less cash to close, from 66 down to 65, but only saves you $94 a month in payment. Okay, so you can kind of take a look here at the payment stream on the 2-1 buy down. So the first 12 months, it's 5%, then 6%, then 7%. Okay, so if you look at over here, the monthly payment differences, and basically $223 a month, the permanent buy down, $578 a month the first year, and then $94 a month with a 3% price drop. And this mortgage coach will calculate the savings over a certain amount of time. Usually defaults to 5 years, but I did it within a 3-year time frame or 36 months. And this is just the savings about what you're saving, because again, it starts at 5, then it goes to 6. So overall, what your overall savings are. And then as far as interest that you're going to pay, down, still the lowest. So in my opinion, at this particular cycle where we're at the rate market, a 2-1 buy down, it's definitely a great option to take a look at with anticipation that rates coming down. At this point in the video, you're probably wondering what a permanent buy down is. I did a video about that scenario. So go ahead and check it out right here. Go and click on that video. Thank you so much for watching. I'll see you on the next one. On this video, I'm going to talk about mortgage discount points, explain what they are for your mortgage, and if they're worth it or not. So we're getting started right now. Hey, what's going on? Welcome back to the channel. I'm Emmett Dempsey, mortgage broker and owner of Treasure Coast Mortgage here in Port St. Lucie, Florida. And welcome to another video. On this channel, I talk more about mortgages, the home buying process, and some cool things around Port St. Lucie and the Treasure Coast. So if you're new here, please think about subscribing. Okay, mortgage discount points. What are they for your mortgage? Are they a good idea? I'm sure you've had those questions. So a mortgage discount point, first let me give you a definition. A 1 point is 1% of the loan. So a $100,000 loan, 1% is $1,000. So what a mortgage discount point is that for $1,000, you're going to buy what's called buying down your rate. So let me give you an example. Say you get quoted what's called a par rate. If you can imagine a seesaw that's even, that's a par rate. That's what it means, no discount points, no point rate. Let's just say it's 4%, which is the undiscounted rate. And of course, that interest rate can be based off of your FICO, what loan type you're doing, how much you're putting down, so all those different things as you know. But this is just an example. So let's say it's 4%, which is the undiscounted rate. So you want to pay 1 point to get down to 3.75. So you have to do the payment difference between 4% over 30 years or 15 years or whatever it is versus 3.75 over 30 years. So that's really the math about whether a discount point works. And the answer I give to all my clients is always, it depends. It depends on your goals, depends on what you want to accomplish, depends on your monthly cash flow needs. If that payment that we quote is too high, then we need to get it down, maybe buying it down if you have the capital, or if you're getting a seller credit, a seller concession from the seller can help buy down your rate. So everything in mortgages is always, it depends. That's my answer generally to everything. It always depends on your personal financial goals. So that's where I always start with. And I always try and lay out your goals visually, on a system called Mortgage Coach. I know if you work with me out, and there's a link in the description about that. Go ahead and leave a comment if you ever had any questions about points. If you paid points, definitely go ahead and leave a comment. I appreciate it. But really, a discount point is an exchange of interest. You're paying prepaid interest today in exchange for a lower rate throughout the life of the loan. So that's in a nutshell what a discount point is. If you want your own consultation, whether discount points are good for you, go to my website, dempseymortgage.com, give me a call. Thank you so much for watching, and I'll see you on the next one. Hey, how you doing? Emmett Dempsey with Treasure Coast Mortgage here in Florida. Today we're talking about the seller rate buy down, what it is, how it can help you as a buyer, as a seller, as a real estate agent or realtor. Because here's what's going on, guys. I know there's some funny memes and videos out there about that apple that anybody will buy for anything. But in case you haven't noticed, things are starting to slow down a little bit, starting to mellow out. In fact, here's an article here I'll share. That talks about how about 20% of listings these days have price drops. Okay. So maybe that's just sellers coming out of the clouds from extremely over ask offers, or it's softening. But no matter how you slice it, there is a shift in the market. I don't believe there's any kind of crash on the horizon just because of supply and demand and demographics. But I think the red hot market of last year is changing. So how do we mitigate that? And this might not be pertinent depending on what area of the country you're in or anything like that. But this is just something that I want to talk to you about. It's called a seller buy down or seller rate buy down, using points to buy down the rate. Okay. But instead of, if you're a seller and, and if you're going to be asked to drop your price, you're getting lower offers. Instead of accepting a lower price, you keep your price up and give half of that requested rate buy down in the form of a seller credit to buy down the buyer's rate. Okay. So how does that work exactly? All right. So here is an example. So this is basically a $500,000 purchase price. Okay. $500,000 purchase price, 450, 5875 rate, payment of 3218. Okay. So the buyer says, no, I want you to drop your price by 20,000. So 480. Okay, cool. So what does that do for a buyer? So it saves them $108. It drops from same rate. This is with 10% down, guys. FYI. So a little bit of mortgage insurance. Okay, so about $60,000 out of pocket. It saves them about $2,600 out of pocket to drop $20,000 in price, because everybody thinks if it's $20,000 off, I get $20,000 less out of pocket. No, because it's all scalable to financing. So when you look at it, just your loan balance goes down by a little bit, and then it's still not that much different out of pocket. But it's more of a psychological thing. So it's $108. Okay. So what if you do, number three, the third column is basically taking $500,000 from here and giving a $10,000 credit, towards the seller's rate. So instead of 5875, buys it down to 5%. Okay. So it takes that down and drops our payment to $2,971, under $3,000, saves them $246. All right. And what is the effect? Like, in order to get the price drop that matches what this does, you'd have to get a $455,000 house, if you matched it to that. So that's roughly, not exactly to the penny, but just a good rule of thumb. So I need like a 50,000 price drop to match the payment, which is how we live every month, as in order to match that to 455. So that is that. So this is, ultimately, the strategy may or might be pertinent to your market. This is just one example. Of course, there's another angle to this, which I'll discuss in another video, about what happens if the price drops. And I did a video, if you search on my channel, about appraisal gap, using mortgage insurance to buy that down. That's kind of how it would be. You can take a portion of that seller buy down, buy out your mortgage insurance, and still keep your payment on. And I'll do an illustration on a future video. But go ahead and hit a like on this video, and go subscribe for more information on mortgages, current rate markets, and of course areas about moving to Florida. So this is just an example of the seller buy down strategy. If you wanted to figure it out, if you're a realtor on the listing side, or if you have a buyer in the market, and maybe be losing out, and you maybe want to make an offer, definitely give me a call. Go to dempseymortgage.com. Thank you so much for watching, and I'll see you guys on the next one.